If you've been wanting to relocate to Charleston, you've probably been doing research and you're wondering if now is the time to make your move. If the recent buzz in the media about lowered mortgage rates has you excited, you're definitely not alone. But will these drops be enough to make the transition easier? Hey, what's up y'all, it's Shawn, your Charleston realtor, and in this video, I want to help answer these questions and talk about the future of real estate in Charleston, South Carolina, going into 2025. And obviously, as a personal disclaimer, don't construe this as financial or loan advice. This is my opinion based on public information at the time I created this video. However, I am an engineer and an MBA by education, so following economic data and macroeconomic trends is part of my job as a real estate agent. It's nearly impossible to predict concisely what's going to happen with the housing market, but a summation of evidence paints a good picture of what we can expect. So with that out of the way, let's dive right in. I think in order to get context of what's happening in Charleston, we really need to go over the real estate market on the national level first. At the end of the day, the housing market is all about supply and demand. If you think back to high school economics and a supply and demand graph, when supply goes up or demand goes down, usually we see a softening in the price. When we insert scarcity into the market and lower supply, or when demand goes up, we see a price increase. Evaluating the effects of supply and demand on both a national and a local level are incredibly important, which leads us to the biggest driver of housing demand, which is interest rates. What does the future of interest rates look like? Well, we know that the Federal Reserve monetary policy impacts Treasury yields through its control of the federal funds rate and the purchasing of bonds. For example, when the Fed raises interest rates, newly issued bonds offer a higher return, making existing bonds with lower returns less attractive. As a result, the price of existing Treasury bonds falls to bring their returns in line with the newer issued bonds. On the other hand, when the Fed lowers interest rates, the value of existing bonds increases because they offer higher returns than the newly issued bonds. This brings us to the 10-year Treasury yield, which is the interest rate that the US government pays to borrow money for 10 years. It's a key indicator of investor sentiment and economic conditions. Mortgage lenders use the 10-year Treasury bill as a reference point to set interest rates because it reflects the cost of borrowing money over a longer period, which kind of aligns with the terms of mortgages. So mortgage interest rates are directly influenced by movements in the 10-year Treasury yield. So there is a positive correlation between the two. When the rate of the 10-year Treasury yield drops, you can expect the mortgage interest rates to drop as well. So what does this mean for the future of interest rates? So as of September 9th, the yield on the 10-year Treasury stood at 3.7%, which means that this rate has been trending slightly downward from earlier in the year when it was at around 4% in July and August. Now, researchers at Morgan Stanley expect 3 rate cuts through the rest of 2024, and each cut would be about 0.25% or 25 basis points. This sentiment, as of now, is echoed by the market expectations because the Federal Reserve themselves has put out guidance that says as much. Just take a look at the summary of economic projections put out by the Federal Reserve. They are targeting a federal funds rate of 5.1% by the end of 2024, a funds rate of 4.1% by the end of 2025, and a funds rate of 3.1% by the end of 2026, with a longer run target of 2.8. Of course, this is merely guidance and is subject to change, but it shows you where the Federal Reserve's head's at. Interest rates are going to be coming down over the next 2 to 3 years. Looking forward into 2025, experts from organizations like Fannie Mae and the Mortgage Bankers Association predict that the 30-year fixed-rate mortgage will be around 5.5 to 6% by the end of 2025, which is obviously lower than it is today. So how do interest rates impact demand? Now, according to Realtor.com, for every 1% drop in mortgage rates, 5 million more households qualify for homeownership. So if experts are correct about mortgage rate predictions for 2025, we could see more than 5 million new buyers enter the market by year's end. Buyers means more competition between buyers, increasing demand and shifting the demand curve to the right, thus increasing prices. Depending on just how many buyers flood back into the market, this could potentially lower supply, thus shifting the supply curve to the left simultaneously and exacerbating the issue. Now, I've covered how an influx of buyers entering the market could affect supply and demand, but what does this mean for people who want to sell their homes with interest rates dropping? Now, I think that now is a good time to talk about what industry experts are calling the lock-in effect. This is a situation in real estate where homeowners are reluctant to sell their home because they have a low mortgage interest rate. I personally know people who want to move and need to move, but they don't want to give up their 2 or 3% interest rate. Now, selling their home would typically mean having to purchase a new home at a higher interest rate, which leads to higher monthly payments. Now, because of this, many homeowners choose to stay in their existing homes instead of entering the market, which contributes to low housing inventory. I agree with this part. However, some people believe that when mortgage interest rates drop, there's going to be a flood of new housing inventory in the market. But this is a fallacy, and here's why. You see, according to Realtor.com, 72% of home sellers who sold their homes in 2022 also bought another home that same year, or at least plan to. In many years, this number is even higher and approaches 80 or even 90%. So I think it's really unlikely that we're going to see much new inventory coming on the market because sellers are now inclined to sell due to lower interest rates, just because they're going to be more inclined to buy because of lower interest rates now, and they're going to go buy that other home. And this time they're going to buy it with a lot of equity and cash on hand. But what does this mean for home prices? With a shortage of housing inventory and more buyers entering the market because of interest rate shopping, this means we are likely going to see home prices increase even more. Unfortunately, this is a problem of our own making. Following the 2008 financial crisis, new home construction slowed dramatically as home builders were so cautious to keep building. This led to significant amounts of underbuilding between 2010 and 2020, which is why we have a significant housing shortage today. Some experts pinned that number between 2 and 10 million units that we are lacking on the national level. Again, supply constraints will likely keep prices fixed where they are, and any changes in demand due to interest rates will likely drive up home prices. So what is the future looking like for real estate in Charleston? Well, experts expect steady price growth continuing through 2025, but at a more moderate pace in the range of 2 to 3% annual appreciation compared to what we saw during the pandemic. Mortgage rates are expected to decline slightly in 2025, which could help out buyers who have been priced out in previous years. We don't expect demand to slow down though. There is a strong job market here with major employers like Boeing, Bosch, and the medical sector. The military has a strong presence as well because of the Air Force and the Navy. Combine all of this with the influx of demand from out-of-state buyers, and it's easy to see why demand isn't slowing down. If you would like to learn more about why Charleston keeps growing, I actually made a video about it. I'll leave the link in the description down below. I do want to touch on the possibility of the US entering a recession and what that means for Charleston. It's uncertain if this is going to happen in the near future, and to be honest, we usually don't know we're going into a recession until we already are in one. Factors like persistent inflation, high interest rates, and weakening consumer demand could contribute to a downturn. According to JP Morgan, there is a 35% chance of a recession occurring before the end of 2024 and a 45% chance of a recession occurring by the end of 2025. If the US goes into a recession, what does this mean for real estate? It really varies depending on where you live, but cities that are more resilient show economic factors such as strong population growth and a strong demand for housing, which means like highly desirable cities like Charleston, it's likely to remain robust even during a recession, though the tourism and hospitality industry may take a hit. Most analysts say that real estate is considered a more resilient asset class during a recession than others, especially in high demand markets. Out of the past 6 major recessions, only one of them had any significant real estate value loss, and that was because real estate was the reason for the recession. We all remember this. It was 2006, 2007, 2008, and banks were giving loans to anyone who was breathing. Or we don't remember it because we were in 7th grade playing RuneScape, but I digress. We also know that people have a record amount of equity in their homes. Take a look at this graph. 76% of homeowners have at least 50% equity in their homes. So we won't see a supply of inventory coming online because of foreclosures. A recession can suppress demand, especially at higher price points, but we shouldn't see any major price reduction, especially here. I was curious about how much prices have changed in the last 2 years in Charleston, so I pulled some data in the MLS in popular markets and compared single-family home prices from July of 2022 to July of 2024. If you want to see the full breakdown, make sure you pause this video, but as you can see from this table, every single market around the peninsula has gone up in value, and I don't see this trend slowing down. And I can't stress this enough. If real estate in Charleston has remained so resilient in an era where the Federal Reserve has increased interest rates at the fastest rate in US history, then can you imagine how Charleston real estate will look when rates actually finally decrease? The tens or even hundreds of thousands of folks who are renting homes in the low country will likely flood back into the market to try to get a little piece of the American dream. Again, supply and demand. I am anticipating the demand curve shifting to the right again when interest rates come down. So what do I think about all of this and the future of real estate here in Charleston? Given this information, I think we're going to see new homebuyers entering the market, especially in areas like Moncks Corner and Somerville, as interest rates continue to drop. The reason for this is that areas geographically closer to the peninsula are more expensive because they're already established and there isn't much room for new development like there is in Somerville or Moncks Corner. These areas tend to be great for first-time homebuyers. But on the flip side, there is going to be suppressed appreciation in Somerville and Moncks Corner compared to areas closer to the peninsula because there is still a ton of builder supply. Take a look at this area I have highlighted in our MLS. In this area, there are less than 180 new construction homes for sale, but nearly half of Charleston's metro lives here. Now take a look at this area just to the north. In this part of the metro, there are over 600 new construction homes presently for sale. Again, it comes down to supply and demand. Constrained supply due to the fact that areas like Charleston, James Island, Mount Pleasant, and North Charleston are already fully developed will increase prices at a faster rate. But regardless, getting into your first home is better than renting. Even with interest rate drops, it's very unlikely that we will see a lot of new inventory becoming available from sellers because most are going to repurchase homes. I believe that this is going to further suppress supply and home prices are going to continue to increase because of the increased demand from lower interest rates. I doubt that the inventory of homes will change much here due to the fact that most sellers are looking to repurchase another home after selling. This means that we will continue to have inventory issues in Charleston as demand outpaces supply and prices will continue to go up. Unfortunately, I really believe that the overwhelming demand due to interest rate reductions will create another housing run that will be similar to 2021, and ultimately we will shift back into a seller's market, especially in highly desirable areas like Mount Pleasant, Charleston City, and James Island. So as a buyer, how can you prepare? If you have the means to purchase now, then I would highly recommend it. Getting you into a home before this surge in demand will only help you in the long run. Interest rates can be refinanced, but your apartment leases don't have that option. And if you're a seller, we may consider holding off selling until early 25 to try to take advantage of increased buyer demand. But then again, everyone's situation is different. What my job as a real estate agent here in Charleston entails is looking at your situation and coming up with a custom strategy to help you meet your real estate goals. I would love to be your resource for real estate here in Charleston. Don't hesitate to send me an email or give me a text. I'd love to chat, and I'll see you in the next video.